Welcome to Chapter 23 of the Wealth Management Essentials course. In this chapter, we're going to talk about portfolio monitoring and performance evaluation. There are 5 different learning objectives, and they will cover portfolio monitoring and portfolio performance evaluation. Now, there are 6 different steps to the portfolio monitoring process. The first step is to verify all client contact information is up to date. Second is verify that all the client's financial information is up to date. Third, you want to determine how often you and your client will meet to discuss the portfolio. 4, stay on top of forecasts for economic and financial markets. If things drastically change, a client's tactical or strategic asset allocation may be affected. And 5, with managed products, review the performance of the fund managers and the funds themselves. And with 6, during quarterly and annual reviews, you'll want to ask your clients if their goals or personal circumstances have changed in any way. Now, with portfolio performance evaluation, there are 2 stages of it. So you have performance measurement, which involves the calculation of the return realized by a portfolio over a specific period of time, which is called the evaluation period. You also have the performance appraisal. So it's an assessment of how well a portfolio has done over that evaluation period. Now, there are going to be a lot of different portfolio reports that can be generated. So here's 2 different examples. You can see it's just a list of the different investments on the left, and it shows the market value and current yield, annualized income, and everything like that. Whereas the one on the right shows the portfolio returns for each month at the bottom. So these are just things that you're going to want to review over time. Again, just make sure that the investments are keeping up with benchmarks, and you don't want to be too fickle to change them all the time. It's just that if you have an investment that might underperform for a lengthy period of time, maybe it's time to switch it up a little bit. Now, there are different ways to calculate return. One is the dollar-weighted return, and so you can see the calculation done here, just with this example, and this is using the financial calculator. So you start with $500,000, $500,000 on March 31st, and then the portfolio grows in value to $540 in April. There's a $22,500 contribution in April, so at the end of April there's $562,500. Portfolio then drops in value, $10,000 is added, and then in June it increases in value as well. So you want to try and figure out what the return on this portfolio is, given that there have been some contributions for different months. And so to calculate this using the financial calculator, you want to go to the data button, and the first thing you'll put in is the $500,000, so that's the initial value of the portfolio. Then you want to put in the different contributions, so the $22,500 and then the $10,000, and then you finally put in the final value, the $598,000. Then you can just calculate the IRR by computing for that, and that will get you the answer to the question. Otherwise, you can write it out using the formula and solve for the dollar-weighted return. Now, with the time-weighted return, it is slightly different, a bit simpler. So time-weighted return eliminates the effect of portfolio cash flows, and it only measures the cumulative performance of the portfolio's investments. So again, it's a similar example, slightly different. So you want to calculate the return for each month. So on April 1st, the value would have been $500,000, $500,000, and it ended up as $540,000 at the end of April. So you want to do 540 divided by 500, so that's an 8% return for that month. In May, you would have started with 550 and it grew to 522, 500, so you actually lost money. And so you can see that the return is negative 5%. And then you want to do the same thing for June. So in June, it started off as 545 and grew to 599. The return is 10%. Then you want to just multiply them all together and subtract 1, and that is the time-weighted return. So a bit simpler. You don't have to use the financial calculator, which is nice. And so this example just goes through how you could calculate a benchmark return. So it says, suppose a client has a strategic asset allocation of 5% cash, 40% Canadian debt securities, and 55% Canadian equity securities. So we know that T-bills would represent cash, so they earn 1%. The bond index, which would be the Canadian debt securities, earn 6.7, and then the S&P TSX Composite Total Return Index is for the equity securities. And so you just do a weighted return. So 5 times the 1% plus 40% times the 6.7, and then the 55% times the 9.5%. And that will give you the benchmark return. So that's what you would compare your portfolio against, since that's the strategic asset allocation. You'd want to compare it to basically an 8% return. If it is above that, the portfolio outperformed the benchmark. If it's below, it underperformed. Now, what makes a good benchmark? So first off, it needs to be investable. So you need to have, you have to measure it against something that you can invest in. There needs to be an unambiguous composition, so you do need to know that breakdown. It needs to be appropriate and attainable. It needs to be specified in advance of investing in that SAA. And it needs to be objectively constructed and easily measurable. Now, some different classes of benchmark portfolios. So you have composite market indexes. So this is comparing the portfolio to a market index. It could be the S&P 500, the Dow Jones, or in Canada, the S&P TSX. So there are a lot of different indexes you can compare to. Most do not include reinvested distributions. So that's why in the example it was talking about the total return composite index, which do include that. Fund managers that use an investment style do not reflect the market index because it incorporates many different styles like growth and value. So if you do have a fund manager who uses more of an active style of investing, then it isn't mirroring an index. It can definitely fluctuate around that. It could outperform, it could underperform just based on their different styles. Next, you have investment style benchmarks, so portfolios that have a highly specific return and risk requirement that are not closely tracked by composite indexes, maybe like small cap or growth stocks, etc. And they still can sometimes not accurately represent a manager's style. A normal portfolio includes all the securities that a manager normally selects from. They control more investment styles if you do use that style of benchmark. Then there's also the Sharpe benchmark, which is created statistically using multiple regression analysis by combining a variety of style indexes, and it is quite useful for style analysis. Now, when looking at the comparison universes, so portfolios or funds are compared to many other portfolios with similar risk characteristics ranked based on past performance. Managers are generally ranked by quartile. So in this example, the portfolio is the red, and you can see the bar are all the different returns from different portfolios with those similar risk characteristics. So the average would be that middle line. So for example, in this year, it's below average, about average, above average. This one's above average, quite a bit above average in the last 2 years. And so that's a good way to measure portfolios, and quite often advisors will use databases such as Morningstar to evaluate different investments, and that automatically just compares it to all the different peers or similar investments, which can be quite helpful when evaluating a specific investment. Next, there's a few different ways to calculate risk-adjusted returns, and so these are formulas that you probably should memorize for the exam. The first one is Jensen's alpha. So it quantifies the degree to which a manager has added value relative to the market given the portfolio's systematic risk. So Jensen's alpha is calculated as the average return on the portfolio over that valuation period minus the risk-free return over that period minus, then you do beta times the difference of the market index and the risk-free return. The other risk-adjusted return is the Sharpe ratio, and so this measures the excess average return per unit of total risk for a given period. So you would calculate it by looking at the average return of the product less the risk-free rate divided by the standard deviation of that product. And finally, Trainer ratio, which is a measure of the average excess return per unit of risk. And so it's just calculated as the difference between the average return and risk-free rate divided by beta. So the same thing as Sharpe ratio, except you're not dividing by the portfolio standard deviation, you're dividing by beta for the Trainer ratio. And so those are all the main concepts for chapter 23. I hope you found the entire review for the Wealth Management Essentials course helpful. If you have any questions about any of the chapters, just let me know in the comments down below and I'll try to help you out as much as I can. Good luck on the exam, and I hope you really enjoyed the entire series.